Welcome to Small Business University Online, powered by Small Business Expo, America's largest business trade show and conference for small business owners. Please be sure to check out our complete webinar schedule and all on-demand recordings from previous webinars on smallbusinessuniversity.online. All of our webinars are full of incredible information to help you grow your business. This webinar is being recorded and will be made available within 24 hours on smallbusinessuniversity.online. In order to ensure optimal sound and video quality during this presentation, please make sure you are logged in using the latest version of Google Chrome. If you encounter any technical issues during the webinar, we suggest that you log out and log back in to reset your system. And now, I'm very excited to introduce today's webinar. Please take it away.
Hey, everybody. You don't know that you don't know. Think about it for a moment. You don't know that you don't know something. And I hear that all the time. I run into landlords and they say, hey, I wish I met you before I sold my place. I run into people all the time where just that they have a whole bunch of disasters and I wish I got to them earlier. Hey, everybody. My name is Mark Lescaray and I am the owner of Mark Ellen Wealth Management. And I am a fee-only registered investment advisor based out of New Jersey. I'm going to show you a whole bunch of exciting things that I witness with clients and prospects. And I know some of you might be serial webinar watchers. You might be seeking out all kinds of education and everything else. And I like you to stop and think for a moment. How much are you going to retain after an hour of that meeting? How about a day, a week? How about a year? How about 5 years? Well, chances are, after a little bit of time, you forget a lot about meetings, but I want this to end with me. I want to tell you stories, and some of these stories are really going to resonate with you. They're true stories. They're true stories of encounters of prospects, clients, and I will explain a lot of tax shelters. So you found me because you wanted to prevent taxes, right? You're selling real estate. Well, I'm going to show you a few other tricks as well. Mostly, a lot of these products, I'm not really getting into the products. A lot of the stuff is for accredited investors, but there is a lot of stuff for non-accredited investors. And what accredited investor is somebody who has $1 million of net worth outside the primary home, or they can do really well with income. They could be making $200,000 or more a year if they're individual. They have to make $300,000 or more if they are filed jointly. So usually a married couple. I find most of the time people are accredited investors when you are a real estate investor, because it's very easy to have $1 million outside of your primary home. That would be your 401k, your savings, your rental properties. So, but anyway, I want to jump to the topics. And when you stay through the meeting, I know it's 45 minutes in this meeting. There is a lot of material in the space. I mean, you literally have to get a PhD to master everything. I'm a master researcher. I play detective, and I find all kinds of issues and problems and new solutions. And let me jump to the next slide in a moment. But for sticking around, this is about a 45-minute presentation. At the end, I'm going to show you a bunch of freebies. One, you could get a free consultation. Two, I have a bunch of articles I'd like to share with you that'll teach very specific topics. So all of you might have one concern, might be your real estate. Another might be selling a stock of Bitcoin and realizing gains. Another one might be optimizing your taxes, Roth conversions, anything in that space too. And also I have a bunch of lunch and dinner events, educational events as well, I could tell you more about at the end of the video. So let's jump to the first slide. So you all found me again because of the message on the top, right? The title, Landlords Reduce Eliminate Capital Gains When You Sell. We will absolutely talk a lot about that. I have tax shelters for landlords. Again, tax shelters if you sell stocks. Actually smart strategies everyone should kind of be doing. It doesn't matter how much money you have, just be smart about it. My next topic will be how to use real estate to avoid capital gains when you sell stock. And I'll focus on this right up in the beginning, is disruption through research and my fee-only capacity. So if I said, for example, hey, save money taxes, I'm an advisor, everyone says, hey, all advisors are the same. I'm here to let you know I'm very different than most advisors. I didn't want to get into the field right away because I felt it was all sales. I didn't want to collect these giant commissions, be a salesman kind of thing. I went into the research path and I had a fun time, decades of research, interviewed hedge fund managers, all the managers of your 401k products, mutual funds, ETFs. And I learned a lot of stuff along the way, and I'm happy to share it with you. But first, let's jump to quick disclosure, and I'll try to keep everything very simple, not too detailed. I'm not going to read much on a slide, but I just want to let you know, so I am an advisor. I am not an accountant. I am not a lawyer. So if you do anything or you're inspired by this and want to do something on your own, always consult a lawyer, always consult an accountant. And if you talk to your advisor too, I'm going to tell you why all advisors are not the same. I'm actually fee only, and we'll discuss that more on there. But it's a big deal. People don't tend to understand that. But let's jump into here. And this is a great story. This is Meet Susie. So this is a prospect that I found. So I used to cold call people. I used to be connected to other people as well. And one person who reached out to me back in, I think it's the end of 2022. And at the end of 2022, if you remember, bonds, right, the broad bond market sold off. The broad bond market lost a little over 13%. Stocks were down a lot, huge. And Susie reached out to me. She said she was very concerned, right? The bonds are going, her investments going down. So what did I do? Well, first of all, she already had an accountant for 10 years, and she had the same advisor for 10 years. And I did a house call. And I went to her house, and I looked over her statements, and I said, "Hey, Susie, where's the rest of your statements? What's going on here?" Well, she didn't have all her statements. She had what was called basically a summary, right? You could see the total assets. It just had the value, no investments in here. I said, "Susie, you don't have all the statements," and she said, she thought she did. So anyway, I had her reach out to her advisor. And she waited, we waited. I went back to my place, came back a few weeks later. She got her other statements from her advisor. And in it, so she disclosed to me that her husband had really, really bad dementia. And her husband was actually going to pass away in a little over a year. Very unfortunate, very, very sorry for Susie. And but when I'm going through the statements, I noticed how she had Microsoft stock, and it was a good portion of her net worth. It was over $500,000, I think more than $500,000 in capital gains alone. And I said, "Susie, why is all this titled in your name?" And she's like, "What do you mean?" I'm like, there's a law here. There's this law where if the assets were titled in her husband's name, when he passes away, she could inherit them through her husband, through what's called a step-up. And in a step-up transaction, so every state's different. New Jersey allows, again, consult your legal attorney on this. New Jersey allows you to eliminate capital gains on a person who passes away. So that Microsoft stock, say it was trading at, I don't know the value, say it's trading at 200 or whatever, and they bought it for $1, right? When you pass away, you're going to have the ability to revalue that stock at $200 a share, not like $1 a share on it. So Susie, with this oversight, again, over $500,000 capital gains, I found it, I pointed out, she was able to have it retitled to her husband's name. And when he passes, she could actually inherit it tax-free from the husband. So I literally saved her over $100,000 on it too. My detective work, and again, I'd like to remind you, she had the same accountant, right? Same advisor, 10 years. And I see this all the time. And I see this with landlords too. They always, I find them after the fact. A lot of people sold a year or two ago, and they say, "Hey, Mark, I wish I found you. Earlier." So again, congratulations for finding me on here. I'm going to teach you a few things. Hopefully, you can prevent some tax disasters. But anyway, Susie, you can tell she's not a landlord. Again, I got to go with concepts where you could avoid taxes, and that's a big deal on here too. But again, I hear all the time, I have a broker, I have an advisor, accountant, I'm fine. And the reality is, just like Susie, you're not fine. I think, I think these people mean well, but the reality is that sometimes you're just too busy and you're a number, right? You're next. And then you never really deep dive in it. Like I said, I like to kind of be a detective work with what I do. So here you are. So here's my big quote. If you explore my website, meet Mark, that's me. People ask me why I'm enthusiastic all the time. And basically, that's it. I'm discovering amazing things like this all the time. I mean, just like Susie, actually, believe it or not, I created the firm. The firm is 4 years old, a little over 4 years old now. That was end of 2022. I was doing a lot of firm reviews and on that time. And I discovered a lot of things. I looked at hundreds of portfolios, heard so many stories, and very interesting. But the one common theme is that almost everybody I talk to, I find something really, really wrong. So don't ever feel you're protected. You got your lawyer, you got your advisor, accountant stuff. I love doing detective stuff. I seem to find it with everybody on here. So here's the boring part. Right after I said I'm enthusiastic, I will read you my disclosures because I literally have to on it. But again, this is it. I'm only going to show you this short thing to read. Other than that, we will continue. Has some really good stories, especially for the landlords waiting. I know. Don't worry. You got some good stuff coming up here. So here you go. Some of the solutions are only available to accredited investors. You could visit my website right there, marklnwm.com, for a full list of disclosures. The SEC defines accredited investor. Hey, that's exactly what I told you. Most of you are going to qualify $1 million in net worth, right, outside of primary home. That means your 401k, your checking, joint account, whatever, outside of primary, your rental property. I mean, pretty easily, especially where I'm at, New Jersey, New York, you pretty much need $1 million or more net worth out of your primary home to retire. So most people are going to qualify in that. The income, people get confused. You don't have to make it. It just means that if you're dead broke, hey, if you're killing it, right, you're making $200,000 a year, you're good. You're making $300,000 married couple, no net worth, you're good also. Again, this is for some private placements I can sell, not everything. And you're going to learn a lot from here too. Also very important, right? This is for educational purposes. It's not any way considered investment advice, recommendation of any product. And again, no investment strategy, a risk management technique could guarantee returns or could eliminate all your risks in any market. And of course, I have the traditional format, ADV, because I'm a registered investment advisor. I'm registered in the state of New Jersey, but I could do business in most states. I'm allowed under the de minimis rule to have a few clients in each. If I hit over a threshold, I will register on that end on it. So that is it from my disclosures. Let's jump to the next story. Here we go. There is. So this is a client. I changed names. I valued the privacy of all my clients, even the prospects as well on it. But I would like you to meet John. And John had the issue of had a lot of concentrated stock, and let's call it. Well, it's not the same company. Let's call it Facebook, right? If somebody is working for companies such as Facebook, you might be rich. You might be rich because of restricted stock options, restricted stock units, and some of these companies, like look at NVIDIA and all the big ones. You own company stock. You're given a lot of shares. You sell this, you can have a lot of capital gains. And the problem is with John especially, more than half your net worth could really be really locked in to your company stock, and you're subject to. And again, it feels freaking good when the stock is going up. I talked to actually, listen, John here, and we were getting him out. He was selling a stock at the 52-week highs, and now it's actually down a lot with the market. So it's pretty good to de-risk. But anyway, it's not a good practice to have like so much in net worth. Usually not more than 5-10% in one stock. In this case, some people, I mean, no joke, like more than half get net worth. And then what is it, right? If you feel confident in these companies, there's no guarantee that 10 years, 20 years, it's going to be good, right? The next maverick companies out there, they may be worthless, right? In 15, 20 years, you got to get out of it. And so anyway, that I was able to get them out of a product. I told John that there is a product called the Qualified Opportunity Zone Fund. And the way it really works is if you sell stock and you have capital gains, you have 180 days to buy Qualified Opportunity Fund. And in that, you don't have to buy the same amount. So for example, right, if you had Facebook, right, you sold it for $1 million. If you had $500,000 of capital gains, you only would have to buy $500,000 of a Qualified Opportunity Zone Fund. And the rest, the other $500,000, you keep to yourself. And what a Qualified Opportunity Zone Fund does is most of them, I can't speak to all, most of them will have a feature where it pays back your taxes. It's going to delay the tax bill. It's going to have your taxes mostly paid for. Some of them pay back 20, 30%. There's another actually I ran into that pays 50% back on it to pay your tax bill. And what you're left with, I was telling John, is he was actually able to sell his Facebook stock, we'll call it Facebook. He was able to delay the tax bill, and that was last year. He was able to buy a Qualified Opportunity Zone Fund, and now when his tax bill comes due, ironically it's coming due in 2026, he will have money back from the product to pay the taxes. And the joke is, I know everyone is, they're always pitching, hey, you know what, you don't pay taxes now. One of the bigger benefits to these funds is that it's held for 10 years. You know, you own real estate, there's different kinds of real estate. I could get the nitty gritty if you get a call with me on it. And after 10 years, it's all tax free. So we'll go back to John, right? Say he sold Facebook, right? $1 million, $500,000 of principal. He keeps himself, $500,000 capital gains. He buys an QZ, gets back something like $150,000 tax day to pay his bills. He now has $500,000 of real estate in the QZ, and it's locked in for 10 years. Say it, you know, for perspective, right? If it's 10 years, getting about 7%. Again, it's always going to vary, but let's say that investment doubles in 10 years, right? So you get $1 million. It's sold all tax free, and you get income too. A good portion of that will also be tax free. So, but anyway, I got John into one of these. Very happy. This is also good with mutual funds, right? So I am again tax shelter specialist, investment advisor. I don't like these mutual funds that pay these distributions again and again. I think it's ridiculous. Why should you have to pay income on stuff when you don't even need it, right? People are reinvesting the distribution again and again. This also works on mutual funds, right? That are paying distributions. I have another client, they're selling their mutual fund. They're realizing the capital gains, but they're delaying it with the QLZs as well. But it's a way to clean up a portfolio so you don't have a constant payout of it. And I'll get more into that in the future at the next slide here. There we go. So here he is. Again, Qualified Opportunity Zone Fund. You could Google it. I have it on my website. I have some articles on it too. In fact, I have 3 videos of how they work. I have these meetings, lunch events, dinner events. I have, there's people that explain these things to you. And at the end of the meeting, a lot of times people say, hey, I still don't get it. I made 3 videos that if you go to my capital gains tax shelter page on my website, it'll show you how it works. And it'll show you the definition, illustration, and kind of what it will do for you. And pretty impressive. I kind of compressed a lot of stuff. Again, I know you guys are busy. Again, I thank you for your time. I want this to be valuable for you. There we go. And now this is for landlords. Very, very exciting. And again, this is like that quote I said at the beginning, right? You don't know that you don't know. And I like it to meet this prospect. I'm looking to win his business. Could offload a lot of real estate. Let's just call him Dan. And he wanted to quit being a landlord. All right. And what do you do? And again, I hear this story again and again and again. And again, I think it's not, again, not everyone's going to know everything. Not everybody's like a tax shelter expert, right? Accountants, they have so busy. And I actually fired a couple of accountants. I fired a friend. Funny story, if you talk to me as well. I fired another guy. I did a search for an accountant I work with. They are hard to find good ones. And I actually teach a lot of them, some tricks as well. But anyway, Dan, he wanted to, he was a hard worker, right? He was doing, I think he was like a doctor, and he was doing a lot of, he was making good money, and he had his own business up in New Jersey. And he owns a lot of real estate all over New Jersey, right? And it's pretty scary, right? The laws and everything else. You always have to worry, right, what happens if that tenant doesn't want to leave, right? You could have 2 miserable years trying to evict them. I think he did have a few issues like that as well. He was a big do-it-yourselfer, right? He wanted to, he actually fixes it up on his own, the property as well. He has several. And, he actually injured his back. And he said, hey, the weather's in New Jersey in winter, I mean, it's getting a little better. But, geez, sometimes it's brutal. I don't blame people for leaving. So Dan, actually, he relocated to Florida. And so he's a big do-it-yourself. He can't fix his properties, and plus he hurt his back. So he wants to sell these properties. And, of course, the accountant, this is a traditional thing. Good job being a landlord these years. You've made a lot of money. And, you don't want to be a landlord anymore. Well, guess what? It's time to pay your taxes. Congratulations. You may also pay your taxes. I'm here to tell you, you may not have to. There's ways to avoid your taxes. And let's jump in here. And again, it's 45 minutes. I don't have a ton of time with you, but a one-on-one will focus a specific issue as well. But anyway, so the accountant obviously knew what a 1031 exchange is, right? It's really a 1031 exchange is when you sell real estate. You follow these rules, right? You got a person called a QI. I'll teach you about it as well. But basically, if a QI, they hold your money, right? And you sell real estate, it goes to a QI. You got 45 days to identify a property. So, think Donald Trump, right? Doesn't like to pay taxes, right? You swap one real estate, pay another, kind of like a 401k rollover, right? If you do it right, you never really pay taxes. You keep on swapping. So anyway, a 1031 exchange, the accountant knew you could sell real estate. If you do the rules 1031, you could own new real estate, pay no taxes on here too. But what the accountant, and most people don't realize, including probably most of you on this as well, is that you could 1031 exchange into a private REIT. It qualifies as like-kind property. So we'll go back to Dan, right? So he has this accountant. Again, he said the accountant's saying, hey, congratulations, no property 1031. Well, guess what? We do have property. And what's the property you get 1031 into? Delaware Statutory Trust. And what it is a private placement. It can own anything, any kind of real estate, right? You could own self-storage, senior housing, hotels. I mean, there's so much to choose from. Multifamily, go by state. It gets a little complicated, and then I could have a special session with you on that as well. I have guides on how they work, but anyway, most of the guys out there who sell Delaware Statutory Trust, they are not fiduciaries. I am a fee-only advisor. That means I don't get a commission from these products I sell, which makes me a disruptor in this space. But I'll get more to that a little bit break. But basically, I could show you pretty much anything you want in there. I'm not beholden to a product as it pays me a commission on here. There we go. So we talked a little bit about the accountant, right, who he knew about 1031s. He didn't know about Delaware Statutory Trust. And so a lot of people, if you Google Delaware Statutory Trust, actually, you probably want to go to my website, and I have the pros and cons of Delaware Statutory Trust. And one of them is it's very expensive, right? You got, non-fiduciaries creating these things, brokers, non-fiduciaries, they're getting a nice commission. It adds up. And so some people understand the rules of a 1031 exchange. Again, it's you sell a property, right? You have a person called a QI. They hold the funds. You identify the property in 45 days. 180 days to close, you complete it, you have a successful 1031. And there's a couple other rules in there too I'll teach you about as well. But anyway, this is a true story. I'd like you to meet, we'll call him Sam. All right, so he knows about the 1031 exchanges. And if you are a landlord, you really should know about 1031 exchanges. It's important. I'm happy to give you a little free coaching, a little bit on that as well. So anyway, to make 1031 exchanges simple, again, I have hours explaining this stuff. To make it simple, you could identify 3 properties for your replacement to avoid taxes. And anyway, this guy, Sam, he had a property, actually, he's guarded by brokers, actually, so I didn't talk to him directly. He had other broker friends, and some of them were reaching out to me. He had basically an apartment in Manhattan, right? $13 million. And I think he had owned it for a very, very long time. So he had a thing called depreciation, right? So if you're a landlord, you probably know what it is. You collect those rents, right? But you get the tax break off of depreciation. When you sell it, you pay $0.05 back on it. He also knew about the capital gains consequences, and most people don't understand how it works, right? So you think 15% capital gain is not a big deal. Hey, you sell a big property, a lot of properties, and make a lot of income in a year. What does it move up to, right? You got the 20%, and then you got the Medicare catch-up, right? That 3.8%. So you got 23.8, plus you got the state, you got any locals. So for instance, in Sam, $13 million of property. He had identified 3 properties, right, for the 1031 exchange. And the rules, they're really, really harsh. I mean, you have 45 days to identify property. And then you got 180 days to close. So he had his 3 properties identified right in the 45 days of it. His Manhattan property, right, sold. So the QI obviously had the funds. And but here's the deal, right? So New York, New Jersey, I'm sure most of the country has similar issues. There's a lot that could go wrong, right? You have environmental issues. You have sellers who change their mind. I mean, I had properties bought and sold. There's always maniacs on the other end. They could botch your sale. So anyway, his deal that he wanted, number one, was it was botched. The seller had a bunch of issues. I think it may have been environmental. And it wasn't going to happen in 180 days. And guess what happened too? His 2 backup properties, right? So he had other real estate that was a backup. Well, the market, it's still pretty hot. It's New Jersey, New York. It's cooling down in some places. They were long gone, right? So he had what he called a botched 1031 exchange. It's pretty brutal on it. So had he had one of these Delaware statutory trusts, so this is again a trust that might own 1 or more properties in there as a backup, he would have been okay. But in here, he not okay, right? The 2 properties gone. So it's $13 million in proceeds. I don't know the exact figures, but I figured, if you had this for many, many years, say you bought it for $1 million, you got $12 million, right? You got cap gains, right? You got the depreciation recapture at Manhattan tax, New York state tax, and this 23.8% on top is more than a third loss to it. And so I do free backups with the Delaware Statutory Trust on that too, so you don't have to pay a dime. If you get a successful deal, like say Sam's deal went through, you'll be okay. But if you had a Delaware Statutory Trust, again, I'll teach you about it and have articles that could go on and on about it as well on it. But anyway, that's the way that some of the stuff works. So anyway, I want you to, 1, never, ever just trust your advisor. Never, ever trust your accountant, right? Always question stuff. What don't I know? What should I be asking? Google it. 1031 exchange failure rate. And I Google it. I got somebody saying 60%. I think it's 50. New Jersey, and here it might even be higher on that too. But on average, Google it. Everyone says different stats. I believe it's close to 50, but Google, if you pull up, one of the first things I see is 60% failure. So even if you're not planning on ever buying a Delaware Statutory Trust, you might want to consider a free backup because, again, you might end up like with Sam, right? You have a botched 1031. The joke is that if you own a Delaware statutory trust, a lot of times you're not committed for a long period. Some of these are 5 or 7 years. So you go back to Sam and say, hey, $13 million of real estate, right? It failed, right? So you had a DST, a $13 million acquisition of a Delaware statutory trust. Well, guess what? In 5 years, they sell this real estate and they go to, hey, Sam, what do you want to do with the proceeds? He could go back to a QI and he could physically buy like a property in Miami, Manhattan, wherever, go back to Manhattan again, buy a place in California and do a 1031 and never pay that $3 million plus tax bill Sam likely paid on here too. So again, the 1031 exchange failure rate, I mean, you just got to Google it and you'll be surprised. But I wouldn't mess around. If you're planning a 1031, reach out. I could get hooked up a free backup if you qualify. And this one is this is a good one. This is a little bit of everything on here too. True, sad story. Prospect, ready to become a client, and his situation. He had owned lots of low-yielding municipal bonds. He was in RMD hell. He hated the rotation of his advisors. And he was always like, pardon my French, but, the B word about taxes, constantly, oh man, ridiculous. And where was he steered toward? He was buying insurance stuff, probably way, way too much on it. So again, a little bit confusing in there too. He had 2 advisors. Neither one was fee only. All right, I'll teach you a little bit of difference between fee only and broker later. But anyway, let's tell you the story of Ron. I went to his house, and I was making house calls, and I still sporadically do here and there as well. He again reached out to me his issues. He was RMD hell. I think that was one of his biggest issues on it, and I pointed out that he was investing the wrong way. And again, I go for max tax efficiency too. I run my own firm here. And one of the things I noticed was that, you have your whole life, right? And you're saving in your 401k and you're hopefully sheltering it at high tax rates, right? And the goal is, at least for Ron, right, making big bucks. I'm talking about big bucks, sheltering all the taxes. And the goal is that hopefully when you're retired, you pay at a lower income tax rate, right? You're making less income. You should be able to get in there. But with Ron, it was quite the contrary. He had loaded up his IRAs full of stocks on her too. And what did he own outside of his IRAs? He owned a bunch of municipal bonds, securities, and paying like the 2 to 3%. And I point out, Ron, your growth, your growth should have been. There's strategies I could show you on here too. Your growth should have been really outside IRA, right? If we didn't have these distributions constantly coming at you, if I could get, I'll show you proposals. Lots of ways of buying investments that don't spit out much distribution at all. And when you pass away, right? Just like with let's go back up here. Back to Susie, right? When you go back up to Susie in here, you have to step up, and the step up is a big thing. When you pass away, right, your family, it gets a step up, and the taxes go away on there too. So Ron, his big issue again, he had all his stocks in his 401k and his IRAs and everything else. He had owned 2-3% municipal bonds, right? I showed him, hey, some treasuries at the time paying 5%. I'm like, okay, maybe we should agree the IRA and 401k a little bit slower, got more of the gains outside of it. And I'll show you some strategies too. There's ways, not all advisors could do the same, but since I'm fee only, I have ways of getting things that don't spit out income, and the distributions. But anyway, unfortunately, Ron, he was in RMD hell, and I think he was ready to onboard as a client. His wife actually didn't want to meet, but she didn't like most advisors. Hey, I can't blame her, right? Advisors kind of have a bad name on it. But I pointed out again, he could have done massive tax savings by actually having a lot of his investments, tax-efficient stock investments, out of side retirement account. And just as he's ready to onboard, unfortunately, he had passed away. And again, it's sad, right? Because he spent his whole life maxing out our 401k, retirement plans. And what happened, right? He actually had several kids, including stepkids as well. And they are, again, kids of executive. They're doing fabulous. They all inherited his IRA, and they're going to get RMD distributions and probably paying at the top tax rate on there too. And I had some ways for Ron to literally avoid the taxes, or actually minimize the taxes. Had he had a lot of the stock outside of his retirement accounts, his kids actually would have inherited tax-free, and he would have been beholden to buying all these complicated, expensive insurance products as well. So unfortunately, family ended up paying taxes at a higher rate when it should have been lower, right? The step up makes the gains go all away. So here we go. This is what I do, what I am. I am a fee-only advisor. As a fee-only advisor, I am forbidden from collecting a commission on any products I sell. It aligns my interest of yours too. And I see here IUL, Index Universal Life. Happy to teach you a few things about that. I don't sell the Index Universal. I'd be forbidden from that. It's again, if I sold you insurance, right, you're going to find out most of your products are going to be insurance related. I can help you figure out if that's appropriate or not. And most of the time, right, it's kind of scared into it as well. But anyway, I'll let you know, fee only is a big deal. One of the most, actually the most strict of the fiduciaries, and the fiduciaries, again, doesn't mean much to people on that until you see the aftermath or repercussions of it as well. And again, I want you to Google, right? So don't even trust your current advisor, your broker, Google it. Two, of all advisors out there, according to Google, right? Google be wrong, whatever, but 2% of all advisors are fee only. And I look at that as really a force of disruption, right? I always say that the space is at least a tax shelter space, right? The Qualified Opportunity Zone Fund, I'll teach you, right? Protects on the stocks. The DST, Delaware Statutory Trust, it's a way of getting out of real estate, no longer being a landlord anymore. Big commissions in there, and I always call it the Wolf of Wall Street. I always say, I don't know if you saw the movie Wolf of Wall Street, like then that was that's the space now in the real estate area. Most people are all brokers. I'm not a broker on it. So when I talk to people like, oh, I'm good, I got a broker. I'm not a broker. And again, the big deal is that one, I could refund a lot of commissions of products, right? So I'm often more than 2/3 the cheaper than everybody else, but more important than cheaper though too, I'm not pitching something just because it pays me a hefty commission. And I'll show you the space, what commission or whatever it charges, it gets refunded or discounted into the products I sell. So it is a big deal. And it's, like I said, Wolf of Wall Street out there too, on that end. And again, I am not a broker, right? If you go to your advisor and say, hey, you're a fiduciary, and of course they're going to say fiduciary. It gets thrown around like that. There's a fee-based broker that says, hey, I'm a fiduciary. I think the question to ask your broker or advisor is, are you always a fiduciary, or are you able to ever collect a commission from any product you recommend or sell? I cannot. That's a difference. That's why I think 90% of the guys out there, the commission only, it puts me as a niche. But hey, things like Index Universal Life, I can't really sell that, pitch it. I could sell you, I could talk to you about some insurance products and bill on that as well. Most of the stuff I do, I do ongoing money management. I do the one-time tax shelters of this. I do project work and planning. I always do a complimentary review, and I tell you what I'm going to find. And I always believe in providing incredible value out there. Everyone, whoever you talk to, your time's important. Make sure that they're showing you incredible value. And for example, right, the conversation, I might point out like, hey, you're paying, $20,000, $30,000 a year, or income tax, right? Cash was paying, 5% at one point. Now it's in the 4s, but look at that. So I have some people I helped out. They're buying a Honda Civic every year in taxes, where taxes owed or income tax. I could teach you some ways where you actually don't pay taxes unless you sell the product. Capital gains if you do, and if you die, you get the step up like that. And that's a big deal on that end. But anyway, happy to teach you again. I think the fee-only advisor approach, right? It's a big deal in this landlord tax sheltered space, stock tax sheltered space, just manage money advisory space too. It is a huge deal, and people don't understand the importance of that too. So you might even want to Google that too, or read some articles at the end of my thing. But again, I'm not going to push you into something, but it pays a hefty commission. Often the thing's the highest commission, not appropriate, right? It kind of it hurts you, right? There's a big commission incentive to push it just because they're not selling as well, right? Some of the things maybe don't pay as nice a commission if they're better for you. But I'll show you anything on there too. And here you go. Here is this is my website. It's markallenwm.com. Again, I have on the left, if you scan the QR code there, it is articles. It is articles. You can read on and on about most topics. And if you don't see it there, you know what? There's a free consultation. Scan it. Send a question like, hey, Mark, I want to learn more about this too. Because again, my firm is 4 years old. I am growing aggressively. And then in this space, it is a powerful niche. Not too many people are in the space that are fee only. It's again a very, very big disruptor in the space. And again, what am I up against, right? What am I up against? Accountants, right? You go, and again, the story. I can't repeat this enough. Again, they're like, hey, congratulations. You made all this money being a landlord. You don't want to be a landlord anymore? Pay your taxes. You did well. Again, I'm here to tell you, you may not have to. And, again, I got to teach that concept. And lo and behold, and then on top of that, again, I have to teach you about the dangers, right? You got a lot of players in here too. You speak to your advisor. Yeah, you might have, again, there might be a broker. There might be a fee bus. But hey, I have Delaware Statutory Trust for you. And it's actually kind of scary. And in fact, that it's scary because, right, you could have $1 million deal, right? And again, this Wolf of Wall Street, not disclosing everything. They have a fine print that discloses things. But you have $1 million deal and you buy a product from them, what's it going to show you? It's going to show you $1 million. A lot of products, right? If I sold you $1 million deal, the commissions get refunded. So in one case, one of the deals is 6.5%. I think one is 6.5%. $65,000. So the new balance will be $1,065,000 as well on it. So I could go on and on about this as well. DSTs, again, I didn't have much time to talk. I say you need a PhD. 45 minutes is not enough. Basically, there's a few concepts how they work. You could do a 1031 with the passive real estate. That's one. But then you keep on flipping it. You call it swap till you drop. I'm happy to teach you more about that. There is another one, DST, where it gets acquired into UPREIT. So you're basically going from being a landlord to, after 3 years, having something that's kind of like a mutual fund. It's really a partnership. It pays you income for life. You don't have to worry about 1031s ever again. You could sell it. You could gift it. It's estate planning on steroids. Amazing. Some of you guys on here is going, hey, I don't want to have my money locked up in a DST forever. And again, I'm a researcher guy. I'm happy to teach you all about it. There's one where you do a 1031 into a DST. You wait a few months on that. They do a cash out refinance. So up to 85% of the cash comes back to you. And what you're left with is, right, you get the cash tax-free. Ironically, not too much different than Index Universal Life. It's a loan, right? Loans are not taxable. You get proceeds back. But in it, you got the money, 85 cents back on the dollar as a loan. Not taxable, right? If you pay the taxes, that's easily 65 cents on the dollar. But you're also left with real estate that has a loan on it, non-recourse loan most often, and it pays down the loan over a series of 10 or 20 years. You have industrial property on the side. Now you can do whatever you want in the cash, right? You can invest in the market, you buy something fun, have a vacation, explore the world a little bit, but you unlocked it, and that's basically free real estate in that. And again, most of this tax shelter stuff for landlords and stocks, the QOZ DST, you have to be a credit investor on it too, but I'm happy to teach you more and on it. Again, I apologize, 45-minute session, but if you retain nothing else from this meeting too, right, no matter what you hear from your current advisor, you count it. There's more to the story, right? Yeah, it's really is. There's more to the story on it, and I'm happy to get down to it. Like I said, I love the research detective, I'm an advisor. I manage money. I do one-time hourly plans, project work. I do manage money. And again, I don't think you have to pay either tax unless you have to. I think it's kind of ridiculous on there too. And my fee-only model is it's huge. And most advisors don't follow it. So even if you ask your advisor, fiduciary, like I said, again, always ask, when are you fiduciary, right? When you sell me that insurance, right, I get a commission, right? I cannot get a commission. So that's a big deal. So again, thank you for your time. I hope some of these stories resonate with you. And again, you scan to learn more. You can read some free articles, explore my capital gains section, my landlord tax shelters, money management, project works. I call the find and fix for my first person I was talking about as well. So thanks again for your time. I appreciate it. And here you go. That's the Susie. Remember that story, Susie, from Nothing Else, right? What we discovered. And that was free meeting on it too. So I don't know, I'll discover a few, but maybe we'll discover something like Susie, or we'll help you out with another advisor. But thanks again for your time. And, I look forward to connecting. I have free events coming up. Actually, you know what? Before you go, I got one more moment here. I have events in Fair Lawn, New Jersey. I have events in Cherry Hill, right near Philadelphia. I have a New York City event, and I have a Bellemeade, Long Island event, and a West Hartford, Connecticut event too. Some of them are lunch or dinner. They teach more about the tax shelters. See if you want to learn more. If you're a credit investor, you qualify, I'll invite you over to one of these events as well. So yeah, free articles, free consultation, free lunch and dinner events. Just right out. And then again, hey, I'm not an ordinary advisor. So glad we found each other, and enjoy. Hope you learned something. Hopefully you remember it a week from now, a year, and 5 years from now. So when your accountant tells you, hey, that tax bill's owed, you're like, nope, there might be another way. But thanks again, everybody. I really appreciate your time.
Thank you so much for that informative presentation. We really enjoyed it. As a reminder, this webinar was recorded and will be available on demand within 24 hours on smallbusinessuniversity.online. Please remember to frequently check out our webinar schedule on smallbusinessuniversity.online for other great weekly business building webinars. Thank you all for joining us, and have a great rest of your day.